Going on, everybody? I want to share with you just a simple rule that I personally have followed over the last, I'd say, 3 or 4 years or so that has really helped me to simplify my trading. Now, for most of you, you'll be like, "Oh, I'm familiar with this," but I really want to share this with you today in a totally different light. I want to give you something to think about because it always seems like these simple things that we're supposed to be following, we overlook. And truth be told, especially in this industry, if you're a trader watching this, everything seems to be complicated. Everybody seems to be overcomplicating what is already complicated. And my philosophy as a trader really is to focus on simplicity. So I want to share with you two core pillars and then three subsets of one of those core pillars, starting with what I like to call the concept. Now, you can call this whatever you want. You can call this your strategy. You can call this your trading approach. It really doesn't matter. But the first core pillar here, as per the 2-3 rule, is what I like to call the concept. And the second pillar is what we call mindset. Now, we're not going to go into mindset today. Our focus is going to be the concept. And the reason for that is because what I'm about to share with you is really the foundation of everything that you as a trader really want to be focusing on more than anything else, and really trying to eradicate all the distractions that then you start to face as you progress on your journey. Now, when we look at the concept here, but there's three subsets. And the first one is what I like to call your strategy. Now, the reason why we're talking about your strategy here is simply because there is so many distractions, what I like to call shiny object syndrome, that most traders end up adopting. And the reason why I'm talking about strategy today is because, firstly, is because most traders think that there is a concept out there that if I learn it, I will then become profitable. And the truth of the matter is, guys, it really doesn't matter what strategy you trade. I'm going to be brutally honest. It could be the two candle theory. It could be break and retest. It could be supply and demand. You could use indicators. You can use whatever you want. No strategy is going to be beneficial to you as a tool if you do not know how to work with it. And especially with social media, YouTube, Instagram, TikTok, you can go anywhere nowadays. And there is tens of thousands of concepts out there that you can adopt without paying a penny for, having to invest any money and learn. And here's the thing, because there is such a variety of concepts out there, strategies, surely the statistics would be different. Because if it boiled down to the strategy, then there wouldn't be a 90 to 95% fail rate in this industry. It's not just about your strategy. So the reason why this is the first subset to the pillar of concept is because the most important thing that you want to be focusing on is finding a strategy that you get excited about, a strategy that you resonate with, and a strategy that you fully believe in. And it doesn't matter what it is. I personally believe, I haven't tested it myself, but I personally believe if you just flipped a coin and it landed on heads and tails, and if it landed on heads, let's say you take a buy, and it landed on tails and you take a sell, I personally believe you could become a profitable trader as long as you use good risk management. Obviously, there's other things to think about, like your discipline, your patience, your consistency, and avoiding doing dumb shit. But other than that, I personally believe that's a possibility. But with all the distractions out there, it is so hard for so many traders to stay stuck with one concept. And the reason for that is because they don't give it enough time. 1 minute it works, the next minute it doesn't. And then they get discouraged, or they go on social media, then you see somebody sharing their blue slips, or they've just flipped X amount to X amount. And then it's like, well, if I use a strategy, this is going to work for me. They say a good worker never blames his tools. And if you're one of those traders that eventually or are or have in the past hop from strategy to strategy, then you, my friend, is that person. A worker that's blaming his tools. Now, you might say, well, this is really simple, Rox. It's not simple. It should be simple, but it's not simple. And here's the truth. If you go into the markets with a demo account and you use a strategy and it works for you, then in theory, when you come into the live markets, there's no reason for it not to work for you. Well, it doesn't work because of this part. Okay. There's other factors that are involved. So, my best advice to you, just before we move on to the second subset here, is find a strategy that gets you excited, that wakes you up in the morning, that you have a strong belief system in, and that you're able to come to the markets and identify how you can implement this strategy and get cracking. Don't expect to get results straight away. Just get cracking. Journal 100 plus trades, whatever it may be, just get cracking. Get rid of all the noises, all the distractions, and what have you. That is my advice to you. Now, the second thing that I want to focus on with you guys in terms of the pillar of concept is the second subset, which is 2 to 3 patterns. Now, guys, I could do a whole 3 hour video on 2 to 3 patterns. I really could, because here's the truth of the matter, guys. Now you've got your strategy, it doesn't mean that strategy is going to work for you when you come to the markets every single time. And the reason for that is because there is this massive misconception that when you show up to the charts on a Monday, Tuesday, Wednesday, Thursday, and Friday, there is going to be a trading opportunity for you. And boy, oh boy, have I seen some of the greatest traders that have ever crossed my path go downhill because of this reason. And the mind is the most amazing asset we have. Asset? The most amazing, whatever, right? The most amazing thing that we human beings have, but yet it is the most damaging and detrimental. And if you haven't got your patterns dialed in, then there is a problem. And you might be saying, well, Rox, what patterns are you talking about? Well, think of it this way. Let's say you're a break and retest trader. Okay. Are you following? You're a break and retest trader now. So you've learned this break and retest strategy. You've learned it from a mentor. You've learned it from a course. You've learned it from YouTube, whatever you've learned it from a book. Okay. So you learn this break and retest strategy. And the underlying theory is once price breaks a structural low, comes back to retest it, we can then look for continuation sells. That's the underlying theory. Now, you come into the markets, it's Monday, and you see that price has broken a key level. It's come back to retest it, and you see 2 pin bars. This is closed bearish, and then the second one has also closed bearish. Okay? Now, you look at this as a break and retest, and you say, this is as per my strategy. I want to take this trade. So what do? You enter the trade on the break of the low, okay, when the new candle opens or when this candle closes, it doesn't matter about the entry. You put your stop loss above, and then bam, the market flies down. You smash your targets. Then you come into the markets on Tuesday, and you see the exact same setup. Price is trending to the downside, comes back to a retest level. You have a really nice pin bar again, same as yesterday, closed bearish. And then you have a nice pin bar here as well, but this one closes bullish. Okay, so you take the trade, and the trade ends up losing. Price just continues to go to the upside. Now you walk away from this and you say to yourself, oh, okay, it's just a loss. Everything's cool. It's just a loss. And then you come back the next day and you do the same thing. Now you do this for a whole month, 4 weeks, 20 trading days. And then you review your journal. And then you see, I went into profit by 3R, then I went back to break even, then I went to minus 3R, then I went back to break even. And you can't work it out. You say to yourself, I'm following my strategy. I'm taking every break and retest trade that sets up, but I just can't seem to find any momentum. Well, based on the pillar of concept, the reason you are not getting results is because you are trading everything as opposed to being laser focused on 2 to 3 patterns. That is it. Because what is the difference between the first example here at the top, the first example, and the second example? Well, the first example, we have a really nice trending market to the downside. We have a break and retest. We have two pin bar rejections, but both pin bar rejections both close bearish. Now, does that mean every time two pin bars close bearish, it's going to go to the downside? No, it just means that this is what has worked for you on this occasion. So you log 25 trades, and out of those 25 trades, you win 50% and you lose 50%. And now you have a plus RV return on your investment. Okay. Now, the second example is exactly the same. It's really clear it trends to the downside. It's a nice break and retest, and we have two pin bars as well. But the intricacy is different. The difference is this closed bullish and this closed bearish. So we had a sentiment of bearish momentum and then a depletion in that bearish momentum closing bullish, and the market went up. Now, does that mean every time a candle closes, two pin bars close bearish and bullish, it goes up? No, it could still go down. But you take 25 of these patterns and you find that you end up losing 20 of these trades and only winning 5. So now when it comes to the journal reviews at the end of the month, you're able to identify what is working and what isn't working. You eradicate what isn't, and you continue to implement what is, which naturally will send your equity curve and you will start to see exponential results. So why is it important that you choose 2 to 3 patterns? Well, so you are not trading everything. That is it. You're laser focused. You can identify what is and what isn't working, and then you can double down. Whatever you do, once you identify those patterns, you can double down. It doesn't mean it's going to work every time. We'll get to that in a minute. But the point is you're getting closer and closer to identifying what will stop this going nuts and how you can become much more comfortable and confident with this. Okay, so that's the second subset. And then the final and third one here under concept, the pillar of concept, is 2 to 3R trades. This part drives me nuts. And I don't want to get too personal on this, but it's not my business. I'm focusing on my journey, right? But there is a massive, massive craze that has entered the industry over the last few years. And it's this idea that you should be targeting 10, 15, 20R trades. Like, why? Just why? Just why? Like, my head just cannot get around it. Let's just say now you got 100K funded and you hit 15 to 20R return, 1% risk per trade. 1R equals 1%. So 15 to 20R means 15 to 20%. You make 15 to 20 grand. How nice is that? Amazing. Amazing. But when you set out to take that challenge and to get funded, you didn't set out to go for 15 to 20R. You set out to go for 2 to 3R or 3 to 4R or 3 to 5R. Why? Well, if I make 2 to 3R a month, I can substitute my monthly salary. If I find consistency, then I can eventually make plans to leave my job. If I make 3 to 5R, I can supplement my monthly salary. I can put 50% away and then I can have enough to cater to my household needs and what have you. If I make 2 to 3% a month, I can help my family. I can support my children. I can support my husband. That's what you set out for in the beginning. And if you say no, then it's just pure lies. Let's just don't watch this anymore. No one ever set out to make 15 to 20R a month. And yes, it is nice. And yes, it would be nice, but it's just not realistic. Or per trade, should I say. It's not realistic. You just doubled down on your strategy. You've just identified your 2 or 3 patterns. Just to make a note on the 2 or 3 pattern things, once you identify them, then you want to go into the markets. You want to make sure that the minute you look at that chart, your entry time frame, the patterns that pop out to you are the patterns that you're going to select to trade for the next 20 trading days. You find 3 of them, 2 to 3 of them. You take screenshots, 2 to 3 screenshots of each pattern, and you pop them in a journal. Once you've done that, you look at them night and day, night and day, night and day, until you breathe them, sleep them, eat them, smell them, hear them, whatever them. So that when you come into the markets and you see them, you take them. Okay? Back to the 2 or 3 trades. You've doubled down on your strategy, you've identified your 2 or 3 patterns, and now you're going to 2 to 3 R targets. The reason you want to do this, guys, is because you need to build what we call proof of concept. And proof of concept simply means you need to see that your strategy and your patterns are working in order for you to continue to be enthusiastic, build a strong belief system, and have faith that if you continue doing what you're doing, regardless of the results, you will get results. Regardless of the immediate results, you will get long-term results. So if you go for 2R target, I'm sure most of you can hit a 2R target. Is that not going to build confidence? If you go for a 3R target and you hit a 3R target, is that not going to build confidence? Of course it is. Now, let me share something with you. And you've probably seen this hundreds, if not thousands of times. It's all over social media. We've all shared it on our Instagrams and what have you. Let me show you something, okay? If you go for a 1 to 3 risk reward ratio target here, and change the color. You go for a 1 to 3 risk reward ratio target here, okay? This is where you're going to be profitable. And on the lower scale, you only need a 30% win rate. Now, I want to put this in perspective for you guys. This means that if you take 10 trades, you are likely to lose 7 of them. Meaning out of the 10 trades, you're only going to win 3. If you take 100 trades, the likelihood of you losing 70 of them, there is a likelihood of you losing 70 of them and only winning 30 of them. So let's use a 10 example. I come into the markets on Monday and I lose. Come into the markets on Tuesday, I lose. Come into the markets on Wednesday and lose. Now, Wednesday, I might feel deflated. I might think to myself, my strategy's not working. These patterns that Rox told me to screenshot are not working. But if you bring your mind back to this, what I'm sharing with you today, which is a 2 or 3R target, you would understand that you've lost 3 in a row. And in theory, you can still lose another 4 until you end up being a profitable trader by winning the last 3. Now, I know it doesn't work like that, 7 losses in a row, then 3 wins and blah, blah, blah. It can work in any sort of order that it comes in. And it probably wouldn't be as bad as a 30% win rate, or maybe it is, I don't know. But the point is this, you might have break evens, stop loss half, partial profits, and it's just going to eventually fluctuate and balance out. The whole point is this, though. I've got my strategy. I've got my 2 to 3 patterns. If I lose 2 or 3 trades, 4, 5, 6, or 7 in a row, should I then be saying to myself, "Oh, now I'm just going to ignore the pillar of concept, and now start going to look for a new strategy and look for new patterns and go for bigger targets, smaller targets"? No. I can sleep easy at night knowing that if I go for a 1 to 3, I'm going to be profitable at a 30% win rate as long as I stick to the plan. Now, let's talk about a 1 to 2 risk reward ratio, right? Because it's technically the same thing. You will be profitable with a 1 to 2 risk reward ratio around 40% of the time. Okay? So that means out of every 10 trades, you're going to lose 4 and win 6. Now, it's lower than obviously the 1 to 3, but let me ask you something. If you can be a profitable trader, only winning 4 out of 10 trades, using a 1 to 2 risk reward ratio, do you not think that is going to build and instill confidence in you with your strategy and your patterns? Or should we just call it the concept that you're using? Absolutely. So why would you want to go for bigger targets when you can go for smaller targets and still be a profitable trader? Because if you put things into perspective, like I said earlier on, you never opted to go for 15 to 20R when you first set out to take your challenge, or, go for your verification funding, trading your personal funds, whatever it may be. You set out to make enough money for you to be comfortable. And it's only that now, the shiny object syndrome, social media, prop firms, isn't that you're now starting to think, oh, if I get a 200K funded account, make 10%, I make 20K a month. Come on now, guys, get a grip of yourselves. You've got to start somewhere, and you've got to start small. And then once you build the confidence, you see proof of concept, you get the results, and you can see that the strategy and the patterns you're trading are delivering, then the world's your oyster at that point. The only thing that you're very likely to tweak, so we're done here now, okay? We get this, we understand this. The reason why we don't go for one to one, let's get here, is because in order to be profitable, you need to be 6% right. That means you need to win 6 out of 10 trades. Not worth it, okay? And no one wants to be a break-even trader. It's good to start there, but we want to make money. Let's keep it real. For a 4 to 1, again, you could be profitable, but well, I guess no, you'll be profitable. But listen to me, just go for the 1 to 3, because how many of you can hit a 1 to 2? And once you hit that 1 to 2, how many of you say after you hit that 1 to 2, oh, price continue down another 1 or 2 are? Go for the 1 to 3s. Okay. Whatever. I'm not going to get into this. You understand this. Okay. I've gone into this enough. So let me just go back here and just make something very clear to you. Your strategy will always remain the same, which is the core of your concept. The 2 to 3 patterns you may tweak and change as time goes on. I'm not going to get into all the intricacies of that, but they may change. And then your targets, 2 to 3 may change as well. But before you start messing around with this and this, you need to get this down to the T. Okay? And these are the most important subsets of the pillar of concept. And this is what I call the 2-3 rule. So we have the 2-3, and then for the mindset, we'll have 3 as well. But we're not going to go into that today. But I just want you guys to really understand, if you find yourself confused, conflicted, looking around, it is probably because you lack belief in your strategy. And if that is the case, I urge you to revisit the strategy you previously used or are using now. If you haven't found one, go back to the one you was using before. And if you are using one, I would like you to approach or trade in with this rule, the 2-3 rule, and figure out how you can simplify again, and simplify even more. Because once you do that, guys, I can promise you, you're going to start to see the light at the end of the tunnel. But if you don't follow this rule, I can promise you, you're going to have a hard time building momentum. And that is why I'm sharing this video with you today. Okay? So I hope it was useful, guys. I hope it was useful. If it was, then it was. If it wasn't, it wasn't. But other than that, I'll see you on the next video. Okay? Take care.